Every trader enters the market with a belief that being right is the path to profit. The novice thinks in terms of outcome, prediction, and correctness. They feel that if they can accurately forecast where price will move, then trading becomes a simple game. Get the direction right and the money follows. But this belief is the root of most trading failure. The market has never been designed to reward accuracy. It is designed to expose your internal weaknesses, to punish emotional attachment, to reveal whether you can operate in an environment where anything can happen at any time. Losing traders chase the need to be right because it satisfies their ego. Winning traders release that need because it interferes with the clarity required to follow their edge. The difference between them is not intelligence, not knowledge, not experience. It is psychological alignment with the true nature of uncertainty. When you operate as if being right is what matters, you put yourself in direct conflict with the market. You interpret every tick as validation or threat. You personalize randomness. You allow fear to override opportunity and allow hope to override risk. You hesitate when you should act, and you overcommit when you should step back. You distort your perception to protect your self-image instead of protecting your capital. And once your emotions take control, the market doesn't have to beat you. You beat yourself long before price proves you wrong. A trader who needs to be right will hold losers because admitting the loss feels like admitting personal failure. They will ignore their stop because the market should turn. They will add to the losing position because they want to redeem their original mistake. Their identity becomes tied to the trade. And every moment they stay in that emotional trap, their capital drains away. Not because the market is cruel, but because their psychology is misaligned with the probability-based nature of trading. Being right is irrelevant. Managing risk and executing consistently is everything. Winning traders understand that the path to becoming rich is built on one thing: neutrality. They don't assign personal meaning to a loss. They don't assign personal glory to a win. They treat each trade as one event in a long, infinite series of events where anything can happen. They know they can follow their edge perfectly and still lose. They know they can break rules and still win. The outcome of any single trade means nothing. What matters is whether their process is repeatable, structured, and free from emotional interference. They don't seek certainty, they seek clarity. They don't seek to be right, they seek to execute. They don't look for the market to confirm their beliefs. They look for the market to show its hand and respond accordingly. The difference in mindset is what separates poverty from wealth in this business. Losing traders analyze charts to satisfy their craving for confirmation. Winning traders analyze themselves to remove the biases that distort their perception. Losing traders believe their job is to predict. Winning traders know their job is to manage risk and follow their edge. Losing traders seek emotional comfort. Winning traders seek emotional neutrality. And because of these differences, the losers stay stuck in cycles of inconsistency, while the winners compound their discipline into financial freedom. To become a winning trader, you must accept one of the most counterintuitive truths in trading: being wrong is normal. Being wrong is expected. Being wrong is part of the game. In fact, being wrong is built into the logic of probability. When you release the need to avoid it, you free yourself to trade with objectivity. When you welcome uncertainty and stop trying to force outcomes, you begin to see the market as it truly is: a dynamic environment of opportunities, not threats. The richest traders in the world understand that their wealth is not a reflection of how often they are right, but how effectively they manage themselves when they are wrong. Success in trading comes from emotional balance. This means you don't attach yourself to any particular outcome. You don't demand that the market reward your timing. You don't expect your analysis to deliver precision. Instead, you align yourself with the probabilities, you define your risk, and you take the trade because it fits your plan, not because you're certain. Certainty is a lie. Probability is the only truth you can rely on. Losing traders fight that truth. Winning traders embrace it. And that acceptance becomes their greatest advantage. When you stop needing to be right, an extraordinary transformation happens. You stop hesitating. You stop chasing. You stop overtrading. You stop fighting the market's natural movement. You stop reacting emotionally to every tick. You start trusting your process. You start recognizing the difference between randomness and opportunity. You start protecting your capital with discipline instead of pride. You start accepting outcomes instead of resisting them. And then, slowly and consistently, you start making money. Not from excitement, not from hope, not from prediction, but from clarity. A trader who has mastered neutrality becomes immune to emotional manipulation. Wins no longer inflate their ego. Losses no longer damage their confidence. They don't have the psychological swings that trap losing traders in cycles of revenge trading, fear of missing out, or impulsive behavior. They operate from a stable internal foundation. They don't react. They respond. And because of that, they can execute their edge with precision, even when the market becomes chaotic. That consistency is what builds wealth. Not tension, not adrenaline, not certainty, consistency. Being right in trading is an illusion. The market is too dynamic, too complex, too unknowable for accuracy to be the foundation of success. The richest traders in the world make fortunes not because they have superior prediction skills, but because they have superior psychological discipline. They know how to lose correctly. They know how to exit without hesitation. They know how to wait for high-quality setups without forcing trades. They know how to protect their mental capital as fiercely as they protect their money. And they know that every moment they let ego take control, they step out of alignment with the market's reality. If you want to move from being a losing trader to a winning trader, you must shift your identity. Stop trying to be right. Start trying to be consistent. Stop seeking validation from the market. Start seeking alignment with probability. Stop treating trading as a test of intelligence. Start treating it as a test of discipline. Wealth comes from the ability to execute your edge repeatedly without emotional interference. And that requires self-mastery, not prediction. The market will always show you who you really are. If you chase the need to be right, it will expose your fear. If you try to control uncertainty, it will expose your illusions. If you avoid losses, it will expose your lack of discipline. But if you approach the market with acceptance, with structure, and with objectivity, it will reward you with the freedom that only consistency can provide. Being right may feel good. It may stroke your ego. It may give you temporary confidence. But it won't make you rich. What makes you rich is neutrality, discipline, risk control, and the ability to execute regardless of how you feel. The trader who masters that becomes unstoppable, not because they control the market, but because they control themselves. And when you finally release the need to be right, you unlock the ability to do the one thing losing traders never achieve: trade with true confidence. Not the confidence of prediction, but the confidence of process. Not the confidence of certainty, but the confidence of probability. This is the confidence that builds wealth. This is the confidence that creates freedom. This is the confidence that transforms a trader from chasing outcomes to consistently producing them. Being right means nothing if it isn't tied to a repeatable, probabilistic process. The market rewards consistency, not ego. This single truth is where most traders fail and where the few who become consistently profitable eventually awaken. When you first step into the world of trading, you're conditioned by life to believe that being correct is the key to success. In school, being right earns praise. In work, being right earns recognition. In everyday life, being right gives you a sense of control, certainty, and competence. But the market is an environment where this conditioning becomes your greatest liability. Here, the need to be right destroys perception, blinds you to opportunity, and seduces you into behavior that undermines your own performance. The irony is that the more you cling to being right, the more consistently you lose. The market is built on uncertainty, pure, unfiltered, and unmanageable. No matter how skilled you are, no matter how much you study, no matter how long you've traded, the outcome of any single trade will always be uncertain. You can have every indicator lined up, every confluence checked, every rule satisfied, and the market can still move against you. Not because you were wrong, but because uncertainty is the nature of the game. When you attach your identity to the outcome of one trade, you immediately create psychological resistance that interferes with your ability to act objectively. You start seeing what you want to see instead of what's actually there. You start forcing trades that don't exist. You start hesitating when opportunities are real. The traders who chase the feeling of being right trade with tension. They cling to predictions as if they were promises. They tell themselves stories about what the market should do. They look for confirmation instead of information. Every move that goes in their favor strengthens their illusion of control, and every move against them attacks their sense of self-worth. They begin to equate losing with personal failure. As soon as a trader internalizes that connection, trading becomes a battlefield, not with the market, but with themselves. Fear and hope take over. Fear of being wrong prevents them from entering valid trades, and hope of price turning around keeps them trapped in invalid ones. This is why ego is so dangerous in trading. Ego demands certainty. Ego demands to be right. Ego demands immediate validation. But trading does not offer any of these things. When ego leads, discipline dies. When ego leads, risk is ignored. When ego leads, your trades stop being expressions of a probability-based edge and become emotional responses to your need for control. The trader who trades from ego is not trading the market. They're trading their internal conflicts, their unresolved emotions, their desire to prove something. The market does not reward emotional needs. It rewards structure, clarity, and repeatable processes. A repeatable process is what transforms randomness into opportunity. It's what allows you to take trade after trade without being emotionally drained, mentally fractured, or psychologically compromised. A probabilistic mindset recognizes that a single trade means nothing. What matters is the distribution of outcomes over a large sample size. You don't need every trade to win. You don't need to predict correctly every time. You simply need to follow your edge consistently enough for the law of large numbers to work in your favor. If your system has a positive expectancy, your job is not to be right. It is to execute. Every deviation from your plan, every emotional decision, every hesitation pulls you out of alignment with your own edge. Consistency is the ultimate edge in trading, and consistency is impossible when you are emotionally attached to outcomes. Think of the difference between a trader who views each trade as a reflection of their identity and a trader who views each trade as one of thousands in a long statistical process. The first trader experiences emotional highs and lows that distort their perception. The second experiences neutrality and clarity. The first trader hesitates, second guesses, and reacts impulsively. The second acts decisively because they are focused on process, not outcome. The first trader is fighting to be right. The second trader is allowing probabilities to play out. In trading, the question is never, is this trade right? The question is, does this trade fit my edge? Does it fit my rules? Does it fit the structure I've committed to? When you follow your rules, the result of any single trade is irrelevant. A loss is simply the cost of doing business. It doesn't mean you were wrong, it means uncertainty played out. A win doesn't mean you were right, it means your edge expressed itself. The winners understand this, the losers fight it. And that difference creates the gap between inconsistency and mastery. Most traders waste years chasing the illusion of certainty. They jump from strategy to strategy searching for a method that will remove randomness, eliminate losses, and make them feel safe. But this search is endless because the market will never provide that comfort. The only thing you can control is your risk, your behavior, and your mindset. You cannot control the market. When a trader finally accepts this truth, they stop looking for certainty and start seeking consistency. They stop chasing the feeling of being right and start focusing on executing their edge. A probabilistic process is built on structure. Structure removes emotional interference. Structure gives you clarity in chaos. It defines your entries, your exits, your risk, and your behavior under all conditions. With structure, you stop improvising trades based on emotion. You stop letting fear push you out early. You stop letting hope keep you in too long. You stop trading what you think should happen and start trading what is actually happening. The market rewards the trader who treats trading as a business, not a personal test. You cannot build a profitable business on impulses. You cannot build a profitable business on hope. You cannot build a profitable business on ego. You build it on consistency, on execution, on discipline, on the ability to repeat the same actions under uncertainty without being emotionally shaken by randomness. This is why the trader with a 40% win rate can become rich while the trader with an 80% win rate stays poor. The second trader needs to be right. They win often, but when they lose catastrophically because they cannot accept being wrong. They don't cut losses, they don't respect risk, they don't follow rules. Their wins feed their ego, and their ego destroys their account. The first trader, however, understands probabilities. They lose often, but their risk is controlled. They win big, lose small, and execute consistently. Over time, they compound. Over time, they grow. Over time, they become the trader others envy because they understand the real game. The greatest shift a trader can make is the shift from outcome dependence to process dependence. When your confidence comes from winning, it's fragile. When your confidence comes from being right, it collapses under pressure. But when your confidence comes from following your process, you become unshakable. You stop asking whether a trade will win or lose and start asking whether you followed your rules. You measure success not by profit but by execution. And ironically, this is the mindset that produces the most profit. The market is merciless to the trader who wants to be right. It exposes every weakness, every fear, every insecurity, but it rewards the trader who embraces uncertainty, manages risk, and acts without emotional attachment. The moment you let go of the need to be right, trading becomes easier. Your vision becomes clearer. Your actions become more precise. You stop fighting the market and start flowing with it. You stop resisting losses and start accepting them. You stop holding unrealistic expectations and start embracing the reality of probabilities. Being right may satisfy your ego, but it won't make you a profitable trader. Being consistent will. A trader who thinks in probabilities, who follows a repeatable process, who acts without emotional interference will outperform every trader who chases the illusion of accuracy. The market is not a place for prediction. It is a place for discipline. It is a place for structure. It is a place for neutrality. And the market rewards those who approach it with that mindset. In the end, the truth is simple. If you want to succeed, stop trying to be right and start trying to be consistent. The market rewards the trader who respects uncertainty, not the one who tries to control it. It rewards the trader who follows their edge, not the one who chases validation. Consistency is the key, and the only path to consistency is releasing the need to be right and replacing it with the commitment to execute a repeatable, probabilistic process. When you do that, the market will finally reveal the opportunities that ego has been hiding from you all along. Winning traders don't seek validation from the market. They seek alignment with probabilities, emotional neutrality, and flawless execution. This distinction seems subtle, almost philosophical, but it is the dividing line between traders who remain trapped in cycles of inconsistency and those who rise into the ranks of mastery. Trading is not a field where confidence can be built on outcomes, because outcomes are random in the short term. It is not a field where your sense of self can survive if it depends on market approval, because the market has no concern for your expectations, your hopes, or your emotional needs. Winning traders know this, accept this, and operate from a place of clarity that losing traders never experience. They don't look to the market for evidence that they are good, smart, or skilled. They have freed themselves from that dependence. What they seek instead is alignment. Alignment with their edge, alignment with their rules, alignment with the probabilities that govern every moment the market is alive. A trader who needs validation cannot stay consistent. They enter trades because they want to feel right. They cling to trades because they want to avoid feeling wrong. They avoid losses because losses threaten their identity, and they chase wins because wins temporarily soothe their internal insecurity. But the market is not a mirror for your emotions. It doesn't reflect back your worth. It doesn't respond to your need to feel competent. If you attach your self-esteem to your results, you become a slave to every tick, every candle, every fluctuation. Your mind swings between hope and panic, confidence and doubt, clarity and confusion. You become reactive rather than deliberate. And once your actions are driven by emotion instead of structure, you lose your ability to see the market objectively. Winning traders understand that emotional neutrality is the foundation of consistency. Neutrality doesn't mean a lack of feeling. It means a lack of attachment. It means that wins don't inflate your ego and losses don't damage your confidence. It means you treat every trade as just one event in a long series of events, none of which has the power to define you. When you can watch the market without projecting meaning onto every movement, you free your mind to respond instead of react. You become capable of acting with precision, not because you know what will happen, but because you have stopped trying to control what you cannot control. Emotional neutrality also gives you access to the one thing that consistently profitable traders possess: a probabilistic mindset. In trading, certainty is an illusion, but probability is a truth. Every setup you take, every trade you execute, every position you size is grounded not in prediction, but in the law of large numbers. You stop evaluating yourself based on individual outcomes and start evaluating yourself based on your ability to follow your edge. The question is no longer was I right, But did I execute according to plan? The trader who can answer yes to that second question builds confidence that is unshakable because it is grounded in process, not outcome. The losing trader confuses a good outcome with good behavior and a bad outcome with bad behavior. They reinforce habits based on how the trade ends, not how the trade was executed. This creates a deeply unstable internal system. They may abandon valid setups because a few losses occurred randomly. They may repeat impulsive behavior because it led to temporary gains. They may build false confidence from a streak of wins or drown in doubt from a streak of losses. They are blown around by randomness, unable to anchor themselves in anything stable. The winning trader, however, builds their entire identity around the ability to follow rules regardless of outcome. They understand that long-term profitability comes from consistency, and consistency comes from flawless execution. Flawless execution is not perfection. It is repetition. It is the discipline to act the same way under pressure, under uncertainty, under temptation, and under emotional stress. It is the ability to execute your plan without hesitation. That kind of discipline is impossible when you are hungry for validation. Every decision becomes a test of worth. Every loss becomes a wound. Every win becomes a hit of dopamine that reinforces the wrong behaviors. The trader who seeks validation cannot execute flawlessly because their mind is too tangled in emotional noise. When you don't need validation, you see the market with clarity. You stop interpreting every move through the lens of your fears. You stop trying to turn profits into proof of your value. You stop treating trading as an emotional experience and start treating it as a statistical game. You understand that your only job is to execute your edge over and over without interference. If the trade wins, it was one outcome in your distribution. If the trade loses, it was one outcome in your distribution. Nothing changes. You keep going. That is what builds consistency. That is what creates mastery. And that is what leads to wealth. Winning traders accept something losing traders resist. The market is not an authority. It is not a teacher. It is not a judge. It does not validate or invalidate. It does not care how you feel or what you believe. It simply moves. Sometimes it aligns with your plan, sometimes it doesn't. Sometimes it rewards your discipline, sometimes it punishes it. But none of that has meaning unless you assign meaning to it. The winning trader understands this deeply. They refuse to make the market responsible for their emotional state. They take full responsibility for their behavior, their reactions, and their choices. When you take responsibility, you no longer depend on outcomes to regulate your emotions. You regulate yourself. You manage yourself. You master yourself. This is why alignment with probabilities matters so much. If you know that your edge is valid, if you know that your rules protect you, if you know that your risk is defined, then you can operate with calm confidence. You don't need to know what will happen next. You only need to know that over many trades, the probabilities will express themselves if you allow them to. Your job is not to force outcomes. Your job is not to predict. Your job is not to prove anything. Your job is to align yourself with the conditions that give your edge the opportunity to play out. This alignment creates freedom. You become free from the emotional chaos that torments inconsistent traders. You become free from the compulsive need to trade. You become free from fear of missing out, fear of being wrong, fear of losing. You become free from the internal storms that cloud your judgment. When you trade from a place of freedom, your decisions become cleaner, your perception becomes sharper, your actions become more deliberate, and over time, deliberate actions repeated consistently produce extraordinary results. The reason winning traders become wealthy is not because they are smarter or luckier or more technically skilled. It is because they have mastered themselves. They have removed the emotional obstacles that prevent others from executing. They have detached their identity from their results. They have accepted the nature of uncertainty instead of resisting it. They have built internal trust by following their rules with discipline. They have cultivated patience, restraint, and clarity. The richness they achieve is not only financial, it is psychological. They trade from abundance rather than from need. Validation-driven traders operate from scarcity. They need wins to feel confident. They need confirmation to feel safe. They need certainty to feel in control. But because the market cannot provide these things reliably, they remain in a perpetual state of anxiety. They sabotage themselves. They violate rules. They widen stops. They cut winners short. They chase losing positions. Their desire for validation makes them easy prey for the market's randomness. But the trader who operates from alignment with probabilities is untouchable. They don't demand that the market make them feel anything. They don't chase external reassurance. They don't cling to outcomes. Instead, they trust their system, trust their rules, and trust their ability to execute. Their confidence is stable because it is internal. Their behavior is consistent because it is disciplined. And their results are profitable because their process is repeatable. The truth is simple. The market is not a place to heal insecurity. It is not a place to prove worth. It is not a place to seek emotional highs. It is a place to practice discipline, neutrality, and objectivity. The traders who internalize this truth rise above the noise. They step into a world where trading becomes calm rather than chaotic. It becomes structured rather than stressful. It becomes a craft rather than a gamble. Winning traders are not looking for permission to trade well. They are not looking for reassurance from the market. They are not looking for evidence that they are good enough. They know who they are. They know their edge. They know their process. They simply execute, trade after trade, day after day, moment after moment, neutral, disciplined, aligned. The richest traders aren't the ones who win the most arguments with the market, but the ones who master themselves enough to follow their edge without hesitation. This truth is simple, yet profoundly difficult to accept, because it destroys the illusion that intelligence, prediction, or analytical brilliance determine trading success. It replaces those comforting illusions with something far more demanding: self-mastery. The market does not reward the loudest convictions, the strongest opinions, or the most persuasive arguments. It rewards alignment with reality, and reality is indifferent to your beliefs, your biases, your hopes, and your fears. Those who try to argue with the market are trying to impose their will on something that cannot be controlled. Those who master themselves learn to flow with the market, not fight against it. Most traders spend their entire careers caught in the trap of needing to be right. They don't just want to catch good moves. They want to prove that their analysis is brilliant, that their understanding is superior, that their predictions are accurate. When a trade moves against them, they feel insulted. When the market breaks their bias, they feel challenged. When price invalidates their idea, they respond emotionally rather than objectively. They widen stops. They hold losers. They add to positions that no longer make sense. They turn a single moment of uncertainty into a personal battle they're determined to win. But the market doesn't care about their determination. It won't bend to their beliefs. It won't respect their analysis. It will simply continue to express itself in ways that reflect the collective actions of millions of participants, each with different motivations and timeframes. Trying to argue with something so complex is an act of pure ego. The trader who argues with the market loses not because their idea is necessarily wrong, but because their attachment blinds them to what's actually happening. They stop seeing the chart. They stop seeing price. They stop seeing risk. Their mind becomes filled with noise, fear, pride, frustration, disbelief. They start trying to force outcomes instead of aligning with probabilities. Their decisions shift from grounded logic to emotional reaction. And once emotions take over, execution becomes sloppy, inconsistent, and unpredictable. Even if they happen to win the argument occasionally, the cost to their psychological stability is enormous. The habits they reinforce are destructive. They may win the battle, but they lose the war. Self-mastery is what separates the traders who survive from the traders who achieve extraordinary success. Self-mastery is not about suppressing emotions. It's about not allowing emotions to interfere with execution. It's about building enough internal trust that you no longer hesitate when your edge presents itself. It's about maintaining clarity even when your mind wants to panic. It's about having the discipline to follow your rules, not because the rules guarantee profits on every trade, but because they guarantee consistency over a large sample of trades. The richest traders understand that hesitation is a symptom of internal conflict. You hesitate when your beliefs are misaligned with the uncertainty of the market. You hesitate when you attach emotional meaning to the outcome. You hesitate when you fear being wrong. You hesitate when your ego is louder than your plan. But the moment you hesitate, you break the rhythm of your edge. You miss entries. You chase entries. You cut winners early. You let losers run. Every hesitation widens the gap between what your system requires and what your mind chooses. You become inconsistent, and inconsistency is the enemy of profitability. Traders who have mastered themselves don't hesitate because they operate from clarity, not emotion. They trust their edge because they've internalized the truth that no single trade matters. Their identity is not threatened by a loss. Their confidence is not inflated by a win. They don't see the market as an adversary, they see it as a neutral environment of opportunities. Their job is not to force outcomes, but to act when conditions align. They don't feel the need to impose their will, they don't feel the need to predict, they don't feel the need to fight. They only feel the need to execute. This kind of internal mastery cannot be faked. It cannot be intellectually understood. It must be experienced. It is built through thousands of repetitions, through countless mistakes, through deep reflection, through the dismantling of emotional patterns that have been conditioned for years. You develop self-mastery by confronting your impulses, your fears, your attachments, your internal narratives. You develop it by learning to accept losses without emotional collapse. You develop it by learning to take profits without greed. You develop it by learning to sit, wait, and do nothing when conditions do not align with your edge. The richest traders have mastered the ability to do nothing just as effortlessly as they execute with speed. Most traders never reach this state because they are trapped in cycles of emotional reactivity. They chase profits because they lack internal patience. They panic during drawdowns because they lack internal stability. They overtrade because they lack internal control. They revenge trade because they lack internal discipline. They treat the market as a source of emotional stimulation rather than a professional environment. Every action is a mirror of their inner world. Trading becomes a reflection of their unresolved psychological weaknesses. The market simply exposes what they have not mastered within themselves. But the traders who achieve true mastery understand that wealth is a byproduct of discipline. They understand that the market is not a puzzle to solve, but an environment to navigate. They understand that the edge itself is only as strong as the trader who executes it. They understand that the real work of trading is internal. They understand that their thoughts and emotions must be trained just as carefully as their technical skills. They understand that their habits determine their outcomes far more than their predictions. The reason the richest traders do not argue with the market is because they have nothing to prove. They don't need to be right, they need to be consistent. They don't need validation, they need alignment. They don't need emotional satisfaction, they need disciplined execution. They have eliminated the psychological noise that clouds the judgment of others. They have replaced emotional impulsiveness with calm observation. They have replaced ego with humility. They have replaced hope with structure. They know that the market is bigger than them, smarter than them, faster than them. They know they cannot control the outcome, only the process. They know that randomness is unavoidable, but ruin is preventable. They know that the only real enemy in trading is internal conflict, so they eliminate that conflict through meticulous self-awareness, rigorous discipline, and unwavering commitment to their rules. This does not mean they are emotionless. It means they are grounded. They have created a psychological environment where emotions do not influence execution. They have built a level of internal trust that allows them to act decisively even in uncertainty. They do not hesitate. They do not flinch. They do not panic. They simply execute, review, refine, and repeat. This is why the richest traders compound faster than others. They are consistent. Consistency comes from discipline. Discipline comes from clarity. Clarity comes from self-mastery. And self-mastery is the result of facing the truth. You cannot master the market until you master yourself. The market does not reward those who win arguments. It rewards those who listen to what it is saying rather than projecting what they want it to say. It rewards those who act without attachment. It rewards those who manage risk ruthlessly. It rewards those who execute their edge even when they don't feel like it. It rewards those who understand that uncertainty is not a threat, but the very thing that makes trading possible. When you stop arguing with the market, you stop fighting reality. When you stop fighting reality, you stop sabotaging yourself. When you stop sabotaging yourself, your edge can finally express itself. And when your edge expresses itself over hundreds of trades, the results become inevitable. The richest traders are not warriors against the market. They are masters of themselves. They don't seek victory through prediction. They don't seek dominance through intellect. They don't seek satisfaction through ego. They seek freedom through discipline. They seek alignment through clarity. They seek success through consistency. And that is why they win, not once, not occasionally, but continuously, predictably, and sustainably. Not because they conquer the market, but because they conquer themselves. In the end, trading rewards only one thing: your ability to stay aligned with your edge. Regardless of what the market throws at you, wealth flows to the trader, who operates from clarity, not ego, from probabilities, not emotional impulses. When you no longer need to be right, you become free to execute flawlessly. When you stop fighting the market, you start flowing with it. And when you trust your system more than your fears, consistency becomes inevitable. The richest traders aren't special. They're simply disciplined enough to do what others won't, follow their edge every single time,